Every single day, millions of hardworking people deposit their money into savings accounts, feeling proud and financially responsible about their decision. They believe that saving money is the safest and smartest thing they can possibly do with their hard-earned income. But here is the brutal truth that banks and financial institutions never want you to fully understand or discover. The very habit that you were taught to build since childhood is quietly and systematically destroying your financial future every single year. Saving money is not protecting your wealth, but it is slowly transferring your wealth to someone else without you even realizing it. By the end of this video, you will completely rethink everything you thought you knew about money and building long-term financial security. Most people were raised to believe that keeping money in a savings account was the responsible and mature thing to do with it. Your parents told you to save, and your teachers told you to save, and every financial advertisement reinforced that same exact message your entire life. But what nobody explained to you was the invisible force that works silently against your savings every single minute of every passing day. That force is called inflation, and it is the single most misunderstood concept in the entire world of personal finance and wealth building. Inflation means that the purchasing power of your money decreases steadily over time, even when the number sitting in your account stays completely the same. In simple terms, $100 today will not buy you the same amount of goods and services that it bought you last year. The number in your account gives you a false sense of security, while the real value of that number shrinks quietly every single month. This is not a theory or an opinion. It is a mathematical certainty that has been happening to savers all over the world for decades. Let us look at this with real numbers so you can see exactly how damaging this process actually is to your personal wealth over time. The average savings account in most countries offers an interest rate of somewhere between 0.5 and 2% per year at best. Meanwhile, inflation has been running at anywhere between 4 and 8% annually over the past several years across nearly every major economy worldwide. That means if your savings account gives you 2%, but inflation is running at 6%, you are losing 4% in real value annually. On a balance of $10,000, that is $400 of real purchasing power silently vanishing from your financial life every single year. Over 10 years, that same $10,000 will have lost roughly a third of its actual real-world purchasing power in practical, everyday terms. You will still see $10,000 on your screen, but that money will only do the job of roughly $6,000 from a decade ago. Every year you leave surplus cash in a savings account, you are essentially accepting a guaranteed loss in real terms and calling it financial responsibility. Now here is the part that will genuinely make you rethink your entire relationship with the banking system and the way it has always operated. When you deposit your money into a savings account, the bank does not simply hold that money safely in a vault on your behalf. The bank takes your money and immediately lends it out to other people and businesses at interest rates of 10 to 20% annually. They give you 1 or 2% interest, while they earn 10 to 20% by using the exact same money that belongs to you. Your savings account is essentially a cheap loan you are giving to a billion-dollar institution so they can grow significantly wealthier using your own money. The bank then uses your deposits to fund mortgages, business loans, and credit cards that generate enormous profits for their shareholders every single quarter. The system was deliberately designed this way, and understanding it clearly is the very first step toward breaking free from financial stagnation, permanently and completely. Now let us talk about what the wealthy actually do differently, because this is where the real financial education begins for most ordinary people. Wealthy people do not keep large amounts of cash sitting idle in savings accounts while inflation quietly eats away at their net worth each year. Instead, they put their money to work by placing it into assets that grow in value consistently faster than the annual rate of inflation. The most common assets wealthy individuals use include index funds, real estate, dividend-paying stocks, and ownership stakes in growing and profitable businesses worldwide. These assets do not just preserve your purchasing power, but they actively multiply it year after year through the extraordinary power of compounding returns over time. The greatest investor in human history is living proof of this exact principle. Warren Buffett did not build his extraordinary fortune by saving money in a bank account and patiently waiting for interest to accumulate over the decades. He built it by acquiring ownership in businesses that grew in value and generated returns that completely outpaced anything a savings account could ever realistically offer. The difference between wealthy people and everyone else is not intelligence or luck. It is simply the decision of where they place their money consistently. There are two types of compounding in this world, and understanding the clear difference between them will completely change how you think about your money. The first type is the compounding that works against you, which is inflation compounding silently on the rising cost of everything you need to buy. The second type is the compounding that works powerfully for you, which is investment returns stacking on top of each other to grow your wealth exponentially. If you invest $10,000 into an index fund averaging 8% annual returns, that money becomes over $21,000 in just 10 years. Leave that same $10,000 in a savings account at 1%, and after 10 years, you will have just $11,046 total. The difference between those two outcomes over a lifetime is not a few $1,000s, but the entire difference between wealth and ongoing financial struggle. Compounding works the same mathematical way, whether it is working for you or against you, and the direction depends entirely on the choices you make today. At this point, many of you are thinking that investing is risky and that savings accounts at least keep your money completely safe and fully guaranteed. That is a completely understandable concern, and it is one that deserves a direct and honest answer rather than being dismissed or minimized in any way. Yes, investing carries short-term volatility, and markets go up and markets go down, and sometimes they drop in very dramatic and deeply unsettling ways. But here is the critical distinction that changes everything when you zoom out and examine the full picture across a much longer investment time horizon. The stock market has never failed to recover and reach new record highs over any 15-year period in the entire recorded history of modern financial markets. Inflation, on the other hand, has never once stopped, and it has been steadily eroding the purchasing power of saved cash for well over a century. The real risk is not investing your money, but leaving it sitting in an account that mathematically guarantees you will lose purchasing power every single year. Now, this does not mean you should empty your savings account tomorrow and place every single dollar into the stock market without any strategy or plan. Savings absolutely have a role to play in a healthy and balanced financial strategy, but that role is far more specific than most people currently practice. Your savings account should hold your emergency fund, which means 3 to 6 months of total living expenses kept liquid and fully accessible at all times. Beyond that emergency cushion, every additional dollar sitting in a low-yield savings account is a dollar actively working against your long-term financial future and independence. Once your emergency fund is fully established, the next logical step is redirecting every surplus dollar into assets that consistently beat inflation and build lasting, real wealth. This single strategic shift from being a saver to becoming an investor is the most important financial transition any ordinary person can make in their lifetime. It does not require a large sum of money to start. Many of the world's best index funds allow you to begin investing with as little as $1. The most important variable in building wealth through investing is not how much money you start with, but how consistently and how early you begin the process. Time in the market is the single greatest advantage available to any investor, and every year you delay is a year of compounding growth permanently lost forever. The world has changed dramatically, but the advice most people are still following about money has not kept pace with that change at all. Saving money made complete sense in a different economic era, but in today's persistently high inflation environment, it has become one of the most quietly damaging financial habits possible. The wealthy are not smarter than you, and they are not luckier than you. They simply learned earlier that money sitting still is money moving backward in value. Your money needs to be working harder than you are, and that only happens when you move it from savings into assets that appreciate consistently over time. The gap between those who build wealth and those who struggle financially is not income. It is the productive deployment of whatever money they already have. Start where you are, use what you have, and make the decision today to stop letting inflation silently consume the financial future you are working so hard to build. If this video opened your eyes to something you had never considered before, then share it immediately with someone who still believes that saving alone is enough. Subscribe to Empire and Money because every single week we break down the financial truths that most people spend their entire lives never fully learning or understanding.